This episode's a little bit different. We're talking about financial independence, retire early. It's a community called FIRE, and we're interviewing one of the top Australians in this game. His name's Dave Gow. He wrote a blog called Strong Money Australia, and he's written a book on top of it. It's amazing how big this community is and how many people love this guy. And if you don't know what it means just financial independence, retiring early. It's all what we're trying to do. It's how do we go from where we are right now to where we want to be in the quickest amount of time. He's got a lot of tips and tricks of how to shorten this gap, how to think about this gap, and what are the actual things to get there. Because people are like, oh, well, I need $200,000 to retire early. Do you really? Do you really need $200,000? Or maybe can you get away with what you're currently on? Like, can you get away with 150? Can you get away with 80? Can you get away with 60? What is it? What is your FIRE number, they call it? So we are interviewing Dave Gow, and he goes through, we're going to talk a lot about shares as well. We do say some negative things about property. Anyway, epic session. I think you're going to enjoy it. Hey everyone, my name is Joe Tucker, and together with Jeff Miles, we created Australia's largest property investment community called Oz Property Investors, and it has 77,000 members. Each week we interview I was going to say property, but this guy is not really property. However, he did get started in property investing. He built his asset base from property investing to then transition into shares. So it's a really diversified conversation, and I think you're going to get some value out of it. If you do like it, subscribe it, do all that kind of stuff. But let's jump into the session and see.
How do you for people who are just starting share investing, what are the kind of core tenets or fundamentals about the way they should think about where they should sort of park their funds? And none of this is financial advice. But yeah, what are those general things that people should be thinking about looking for?
I would say, firstly, don't do what you guys did. Don't pick individual shares. That's probably the best place to have a bad experience. So it tends to be a much wiser decision to invest in funds that are diversified. So investing in 300 or 500 companies all in one bundle rather than a single share, which is beholden to the moves of the business world and the opinions of market analysts and things like that can force its price up and down quite a bit. But if you own a large bundle of shares in a diversified fund, that's way less likely to happen, and you're way more, I suppose there's way more long-term certainty over your investment, because you're not just investing in one company, you're not just investing in one industry, you're investing in, many times if it's something like an index fund, you're investing essentially in the economy as a whole. So in a whole lot of big businesses, medium businesses, small businesses from about 8 different sectors, and you can invest in companies all around the world. So it's very, very easy to diversify, and because it's easy, it's something that you should definitely do, because it's not that simple to just pick a share that you think is going to outperform and then buy it and then hope it goes to the moon or something like that, because there's thousands of people who are kind of scouring the same information as we are, as everyday people. So the idea that we're going to do better than they are is quite laughable and almost a bit arrogant when you think about it. So it tends to be better if you can diversify into funds and have ones that have low management fees as well, because evidence shows that funds with lower fees tend to perform better over the long run. So those are 2 very simple criteria that if you stick to, you'll do much better on average than picking individual shares.
You like to put a large sum into index funds and then just leave it there, or do you keep adding to the fund to make it grow? Can you talk to us about that?
Dollar cost average, or is it a lump sum, I suppose, is the question.
Well, what the hell is dollar?
Yeah, so I guess it depends what you're trying to do. If you're trying to build the portfolio, then obviously you want to keep adding to it as much as possible. Just like if you're trying to grow a property portfolio, you just keep accumulating as much as possible, because you're thinking, okay, in 10 years, I'm going to be in an awesome spot. So it doesn't really make much sense to put a chunk into an index fund, for example, and then just with the rest of your savings each month, just sit it in cash. Like I don't see what the point of that is, unless you're keeping that cash for a specific reason. So it is better if you can just keep adding as much as you can to the portfolio. And then that not only does that help grow the portfolio, but then when the market goes up and down and has these fluctuations, the months that the market goes down, when you're putting your money in, it actually stretches further and buys more shares that month. Yeah, and then it'll buy less shares when the market happens to be up that month. So what happens is over a certain period, 5 or 10 years, you end up actually buying more of your shares when prices are lower without actually doing anything different. You're just putting in your regular money. And so you're kind of effortlessly timing the market and always buying more at the lower price without even thinking about it, which is a pretty cool benefit of doing that dollar cost averaging.
Yeah.
What's the one action watchers can do to light their financial independence, retire early today? Boots on the ground, track spending, dollar cost averaging, etc. Like, what is the key action someone needs to take?
Man, that's tough because
this pressure's on. Thanks, fella.
The best action will depend on the person and what, if I looked at a situation, I'll be like, okay, this is what they need to do. If I looked at another one, I'll be like, okay, this is what they need to do. Man, that's super difficult. I would say I'll give a few things because I can't think of one best one. So you're going to need to figure out how much you're spending and then question whether you're getting true value for that spending and whether those things are actually making you happy or whether they're just habits that you've accumulated over time. And then related to that, find out really what your FIRE number is or how much you need to create the income that you want. Because if you don't know, you need to know where you're going, and you need like a concrete thing to kind of focus on all the time to keep you on track. And then the third thing I would say is once you have your numbers kind of nailed down, then just focus and just do it. Don't get distracted by a different strategy unless it kind of makes sense to do so later when you re-examine your situation, because you still need to re-examine your situation. But don't get distracted by some shiny new thing. Don't get distracted by recession talk and terrible predictions and things like that. Just like have your strategy and focus on it and just go. And then like stop and reassess, that's fine. But just kind of ignore everything else and just focus and just go.
Solid advice. What about you, Jeff? Have you got what would your advice be to the people?
This is general advice, but no, I would say for me, it's about getting invested. I mean, I know that's super cliche, but to me, in reading Dave's book and just reflecting upon my own journey, the thing that has held me back at various times is actually just overthinking it and saying, well, I don't know if I should do this now. Like there's so many other things I need to be doing with my life. Like I need to shore up my job. I need to shore up my sort of, I need to go on this trip. I need to pay for this thing or that thing. And it's that kind of, even the Dr. Seuss, like everybody's like waiting for something to happen. They're waiting for the phone to ring. They're waiting to go out on Friday night. They're just waiting for that thing. There's no sign that's going to come up in your background and no confetti. It's just actually getting invested in the game, because I think that's how you got to financial independence by 28, Dave. It's you just kind of kept taking action, whether that was property and whether that was, then you realize, look, maybe I need to take a different path. And once you kind of found that North Star, you said, that's where I want to go. So to me, it's kind of taking action, whether that's your first action is maybe getting your finances, understanding what money you need. And if you're not clear, once you're clear on that, then take the next step, keep putting one foot in front of the other. What about you, Joe?
Yeah, great. So I work with a lot of high value investors, right? People that have done incredibly well. And then I speak to a lot of brand new investors that are just starting their journey. And then I meet people that are kind of in the middle. And the biggest thing that I see is it's going back to what you just said there, Jeff, not taking action. They get so worked up about the minor details, and they get so like, it's no, macro fundamentally, does this area, does this thing, does this all fit with what's kind of fits for you? Yes, great, make it happen, go. And then I have conversations with other people, and it's like, no, well, the walls are painted red. I don't really like this property. And it's like, you're missing the forest for the trees. Like that's a $5,000 fix, and you're getting the property $10,000 less. The money's in there for you to be able to do that. And the people that I really, really see succeed are They just go, it's the action. And sometimes you make mistakes, but you don't ever invest the full kitty, so that mistake is going to be life-threatening. Or de-risk the investment as much as you can by getting, professional help, people that have done what you're trying to do to get to where you're looking to go. It's just like in property development. I see people trying to do property development all by themselves, and I'm like, why the hell are you doing that? Like, you have no idea. You're going to spend all this time. You're going to spend 6 months getting educated. Do a development with someone else. Go do a joint venture with someone who's already done that path. Get educated, and then maybe go out and do it. You're still going to make a slice of the pie, but for me, it's action. Just pull the damn trigger and make it happen. But there is a knowledge foundation base that you need to get to.
You sort of said you hit the serviceability wall after a couple of properties between yourself and your partner. If you hadn't hit that serviceability wall, do you think you would have still kept going, or would you think you would have discovered shares anyway? What are your thoughts on that?
That's a really good question.
Juicy.
I've probably never thought about that.
Jeez, sorry, I put you on the spot here.
I probably would have. Look, honestly, I probably would have kept going, because it was actually hitting that wall that then is when I'm like, okay, what am I going to do now? Do I want to keep investing in something? But that was kind of my prompt to look elsewhere. So I suppose without that prompt, I would have continued where I was going. I do think that at some point, though, probably not too long after that, I would have been still looking at like what the end game was going to be, and then doing the numbers and being like, okay, this probably isn't going to work the way I think it's going to work. And then I would have had the same sort of realization, I think. But it probably would have taken a little bit longer to get there without that earlier prompt and hitting that wall.
Detractors that made you sort of switch across or pivot to shares?
I suppose the main one, which I kind of mentioned before, was just that even if they're paid off, the properties in most capital cities of Australia, the net yields are going to be pretty poor, like 2%, maybe 2.5%. So it's just was that comparison of, okay, if I park my savings here, I get this much. If I park my savings here, I get that much. Because we actually, as we spoke about before the show started, I don't really care that much what asset class I'm invested in. I care what that asset class is going to do for me and whether it actually matches what I want. So I'm not like an anti-property guy. I'm not like a super pro shares guy. I don't really care. I just want the asset that's going to give me what I want. I don't really care which one that is. So that's part of it, I guess. So I was happy to switch if I, could see that I was going to get a better outcome in terms of income to live off from shares. The other thing that is probably worth mentioning is that with the leverage discussion, it's fine to, like, you can get good gains from leverage over a reasonable period of time. But I think one thing people also forget is to keep those leveraged gains and those like high, you essentially get a high return on equity because you put in a smallish amount of equity, you get decent percentage growth, and you magnifies your return. But as your equity in the property grows, that return actually goes down because you've got more invested to get the same amount of growth. So your percentage return actually begins shrinking. And so eventually you get to the point, if you compare the other extreme where the property is paid off, so there's zero leverage, the total return is probably not going to be very good at all because there's no leverage. So you get to some point where the return actually falls below a point that's attractive. And so you actually have to keep the leverage at a reasonably high level to keep getting those higher compound returns than you can get elsewhere. But to do that, that also means you're not going to be getting any sort of positive income from the property, which means you need to keep your debt high and you need to keep working forever to keep these properties kind of compounding at a high rate. So to kind of break that scenario and eventually retire at some point, it's an unsustainable scenario. You can only do it if you keep working. And if you don't want to keep working, you have to kind of break that cycle and do something different, because that scenario is not going to also let you keep high returns and be retired at the same time. It's just not really going to work like that.
And I wonder why people are so scared to do anything. We talk about property like so much. You talk about shares so much, and it's all the pros and all the cons. And it does get so confusing. So I do understand why people don't take action. It is don't feel bad, but it is good to have that education as well. See a lot of people trip up as well. Is this guy? I was writing a comment, and he jumped in. He's like, "Yeah, well, Dave said he would never. He's now transitioning out of property and he's going into shares, and he's like, I'm just starting my journey and I'm going to do that." And I'm like, well, just hold your horses a little bit. Obviously, do whatever's best for you, not financial advice, all that stuff. But it's like, don't look so far ahead at what Warren Buffett is doing and try and leverage, whatever, Amazon and Google and all of that stuff. Take the first couple of steps and maybe, get those people that are a few steps ahead of you rather than trying to emulate what someone at their last point is, because their last point is not your beginning point. Your beginning point is going to look like their beginning point, but also, 10 years ago, property investing in WA was very different. So it's like, cool, you need to do what people who are like Dave are doing right now and ride their coattails. I like that. I like that idea.
It's interesting you say that you're not so necessarily wedded to property. I think that's a very positive and healthy mindset. And I don't think it's something that many people have, to be honest. I think whatever the asset class, people get very, very attached to it. Like it becomes almost part of their identity. They get emotionally attached to it, and they're not able and not willing to look at a different scenario where their decision might not have been the best decision, and when taking a different course might be actually what's needed. So I tend to find that a lot with property investors, to be honest. And I was probably that way as well, because if you're so focused and so passionate on something, obviously all you're thinking about is the benefits from that asset. But it does pay to zoom out and think about, okay, if I, what are my next steps, and then what's going to get me from where I am now to where I want to get to. So I find that from doing my writing, my blog, and even the book as well, it is starting to open some people's minds that might not have been open to the idea of shares before, because as we said in the beginning, it is an asset class that doesn't really come naturally to most of us. So we do kind of shy away from it just automatically. So I think that's a positive thing. And I've noticed that people are able to, when you're able to start questioning things, it can really mean the difference between retiring in 5 years and retiring in 10 or 15 years, because you're stubbornly trying to cling on to the same asset class and the same strategy that you've always done. So it can make, it's not just the pros and cons of this and that. It can really mean, an extra 5 years of freedom across your entire life. So it can make a pretty big difference, and that's a significant amount of free time that someone might not otherwise have if they don't kind of open their mind to different ideas. So it's just the point of opening your mind to different ideas and not becoming too attached to one thing or the other.
But it goes back to what we're talking about. Like, stop getting crazy educated on shares and crypto and then property and then jumping around. So there is a bit of a conundrum there, isn't there? It's you only have so much time to get knowledgeable on two topics before you run out of time. You don't. So I can see why these communities and these things foster, and there are little silos, because people just don't have the capacity to spread themselves across all the assets to see the true value of timing and when it is. Where I see people, like, from a red flag for me for property investors is, oh, cool, I want to get out in 3 to 5 years. I'm like, property's not for you. Don't property unless you're a property developer. Property, if you're buying, hold, investor, it's not going to work. If you're just going to do buy and hold and no work involved.
What are some of the challenges that people, when they first get into their share investing, they're like, okay, like I've got my chess number, which is I don't know, don't know what the acronym means, but it's the thing you need to then generally buy the shares in Australia. You got that all sorted, you got it set up. What are some of the challenges people face after that, and how do they start to overcome that knowledge gap that they may have?
Good question. I suppose there's a lot of different ways we could approach that. I would say that the most common problems people have are trying to pick their own shares. Once they kind of break through that barrier and think, okay, maybe I'll just kind of buy the haystack instead of trying to find the needle in the haystack, then it becomes a case of trying to find the best time to invest in shares. So they're like constantly looking at the market and they're like, oh, maybe tomorrow or maybe next week or maybe this, maybe that. They start reading all the financial news and start thinking they can figure out when the best time to buy is. And they start thinking that because they read the news, they kind of know what's coming next, but they're forgetting that everybody else reads the news too. And then quite often the news is already factored into the price levels of various companies because people have kind of forecasted the news coming 6 months ago, but you're just reading the news article today and thinking, oh, I know what's going to happen. I'll just pause my investing now and wait for a bit because there's a recession coming. It's it's just laughable. There's so many people that are smarter than us that kind of know a lot more, have a lot more powerful data than we do. So the idea of trying to find the best time to invest is like, it's just going to be a nightmare to try and figure out in practice. It's just not going to work. So once you break through that barrier, then you obviously build a plan around investing on a regular basis. So I think once you do those two things, you're a lot of the way there, to be honest, because you're already diversifying. You're buying kind of smart, sensible choices and diversified funds. And then you're investing on a regular basis. Those are kind of like the two biggest hurdles that I see people come across. Because if you just keep taking that very simple action of investing your savings on a regular basis, there's not that many things that can go off track. Yes, the market will go down, but remember, that's an opportunity for you to then buy more. If you can, buy as much as you can when prices go down. So if you can do that, I mean, you're a lot of the way there.